Welcome to this explainer, where we're going to dive deep into Phillips 66's absolutely expectation-shattering second quarter of 2026. If you've been following the energy markets recently, you know that finding a company that's firing on all cylinders is pretty rare. But Phillips 66 has managed to do exactly that. Today, we're going to unpack just how they pulled off this blockbuster quarter, and we'll be pulling the data straight from their financial reports and recent market analyses.
Here's a quick roadmap of what we'll cover today. First, their phenomenal second quarter, followed by the massive Western Gateway Pipeline project. Then we'll look at their shareholder returns, see what Wall Street thinks, and wrap up with some key risks and our conclusion.
All right, let's jump right into Section 1, a truly phenomenal second quarter.
So you might be wondering, just how big was this Q2? I mean, the sheer scale of their financial results caught almost everyone off guard. Wall Street obviously had high hopes going in, but ask yourself, just how much can a massive energy giant really beat the street in a single quarter? Analysts had their models locked in. They expected strong demand, but reality completely blew past even the most wildly optimistic estimates.
Get this, they reported an adjusted earnings per share of $9.41. It's just a massive bottom-line explosion, and it drove their total revenues up over 56% to a staggering $52 billion for the quarter. Honestly, that revenue figure alone beat the consensus estimate by nearly 44%.
When you look at the progression here, it's pretty wild. They were expected to hit $7.68 a share, but they actually delivered that $9.41. To put that into perspective, if you look back at the $2.38 they reported at this exact same time last year, you're looking at a jaw-dropping 295% jump year over year. Basically, it's a 22.5% beat over what the smartest minds on Wall Street thought was even possible.
Okay, so the obvious question is, how did they do it? Well, this breakdown really tells the whole story. The refining segment was absolutely the star of the show here. They nearly multiplied their income by 8. It jumped from $392 million to an unbelievable $3.09 billion. And they did that by more than doubling their realized refining margins. But it wasn't just refining. Chemicals and renewables completely flipped the script on last year's struggles, turning previous weak results and outright losses into nearly $1 billion of combined pre-tax income.
As CEO Mark Lasher pointed out, this isn't just about getting lucky with the market, it's really about operational excellence. They've been going through this leaner, more agile transformation, and it's allowing their refining system to operate at a crazy 96% crude capacity utilization. When your assets are running that efficiently in a constructive market, well, you get the blowout numbers we just talked about.
Let's keep the momentum going and move to Section 2, the Western Gateway Pipeline project. Now, killer earnings are great for today, but physical infrastructure is what secures tomorrow, right? Announced in August 2026, the Western Gateway project is an absolute behemoth. We're talking about a $5 billion, 1,300-mile pipeline system that's going to move up to 320,000 barrels per day. The strategy here is honestly brilliant. They're racing to link the Gulf Coast and St. Louis directly to relatively isolated West Coast markets, and they're doing this just ahead of planned California refinery closures. It's essentially creating a massive, reliable fuel artery for a market that is historically vulnerable to price spikes.
What's super interesting here is the strategic partnership behind this venture. Phillips 66 is putting up $2.5 billion in cash to own the lion's share, 49.9% of the joint venture. And they're partnering with Kinder Morgan, who is bringing some really valuable existing pipeline assets to the table to reverse flow, along with HF Sinclair. It's a powerhouse coalition. They get to share the capital burden while still securing an immense strategic advantage.
The timeline for this is definitely aggressive, but it's also highly secure financially. Moving from today's final investment decision, they're gunning for a 2029 completion. But here's the real kicker for investors. The revenue from this pipeline is strictly underpinned by 10-year take-or-pay contracts. That basically means no matter how volumes fluctuate, the baseline cash flow for this $5 billion asset is completely locked in through 2039.
Lasher really emphasizes that this perfectly connects their central corridor assets to those growing Western markets. And UBS analysts absolutely agree, noting that it's a major positive because it allows Phillips 66 to efficiently move product west during the winter months, when demand is traditionally a lot softer in the Midwest. It's just a masterclass in mitigating geographical risk.
All right, Section 3, let's talk massive shareholder returns.
Because let's face it, record cash flows need a destination. And for Phillips 66, that destination is your portfolio. They just bumped up their equity buyback authorization by $10 billion.
That brings their total ongoing program to a staggering $23 billion, which is literally almost 12% of all their outstanding shares. By aggressively shrinking the pie like this, every remaining share you hold has a larger claim on those record earnings.
And hey, it's not just buybacks. In Q2 alone, they returned a total of $887 million directly to shareholders. That includes over $500 million paid out in dividends at $1.27 a share. But honestly, perhaps the most impressive feat of financial engineering here is the massive cleanup on their balance sheet. They slashed total debt by $6.6 billion, bringing it down to $20.6 billion. That actually accelerates their timeline to hit their $17 billion debt target, a full year ahead of schedule.
Let's pivot to Section 4 and see Wall Street's verdict.
So with the stock up roughly 80% year-to-date in 2026, well, quality comes at a price. The consensus analyst rating is a solid buy. But as you can see, Phillips 66 is currently trading at a forward price-to-earnings ratio of 10.84. That's a pretty notable premium compared to the broader industry average of 9.57. The market is clearly happy to pay up for their flawless execution, but it does mean expectations going forward are sky high.
But even with that premium valuation, the major players on Wall Street remain largely bullish. Firms like Evercore, TD Cowen, and Wells Fargo have all recently bumped up their price targets. They're seeing strong support from the U.S. Energy Information Administration's projection that West Texas Intermediate crude prices are going to average over $80 a barrel in 2026. Even Goldman Sachs, who has a neutral rating, is maintaining a highly elevated target of $245.
Which brings us to our final part, Section 5, Key Risks and our conclusion.
Look, no explainer is complete without an objective reality check. Because as amazing as things are going, energy is an inherently volatile game, right? You absolutely have to consider these 5 critical risks. First off, refining is heavily cyclical and very macro-sensitive. Second, we can't forget the first quarter of this year where they took an $839 million hit in derivative losses. Third, there's intense policy uncertainty out there. Renewable identification number credits from foreign feedstocks could literally be slashed in half after 2027. Fourth, while it is improving rapidly, their $20.6 billion debt is still billions of dollars above management's ultimate $17 billion target. And finally, that premium valuation we just talked about, it leaves very little cushion if market conditions suddenly decide to soften.
So, here's the bottom line. The company is absolutely firing on all cylinders today. But analysts are fully expecting this massive earnings spike to normalize, and they're forecasting a drop back down to about $21.42 per share in 2027. So you really have to ask yourself, with the stock already up 80% this year, is there any margin for disappointment left in the price? Or does the brilliant long-term strategic play of that Western Gateway pipeline make this a premium that's just simply worth paying?